I'm going to tell you what nobody else is willing to tell you. Yes, the housing market is too expensive right now. Home prices have increased 54% since January of 2020, and now we're in the midst of an affordability crisis. Look at this chart by the Atlanta Fed. It shows the cost of home ownership as a percentage of the median income, and we're at the highest level in 2 decades, rivaled only by the housing bubble that led to the GFC. This second chart shows the median household income in blue, and the orange line is the amount someone needs to earn to keep home ownership costs at a reasonable 30%. Clearly, something is very wrong with the US housing market, and in this video, we're going to talk about how we got here, and then look at the financial engineering going on behind the scenes to figure out where the US housing market is going next. So we're going to split this video up into 3 parts. We're going to talk about the affordable supply myth, government and central bank intervention, and the end of a 40-year bull market. Let's start with the affordable supply myth. If you've been tracking the US economy or following the news at all in the last 2 years, you've likely heard these narratives.
I think we're going to need a lot more reductions in mortgage rates, but we're also going to need an increase in supply when it comes to affordable housing.
This crisis is really being driven by this gap between a lot of demand and not enough supply of homes.
The 2 most common phrases you'll hear are, we need more supply and interest rates need to come down. If these 2 things happen, the housing market's going to miraculously heal itself. I do not believe these narratives. I do think there are explanations for why housing is so expensive, but I do not think that there are easy solutions to where we're at right now. But before we talk about solutions to the problem, let's figure out how we got here, because here's the main point of this video. Everyone says they want more affordable housing, but they don't want their home to become more affordable. And this is why the housing market feels so weird right now, because if you're not in the housing market and you're seeing how high prices have gotten, how high interest rates have gotten, and you're trying to get into the housing market, what you're hearing, the narratives that are trying to explain what the problem is or even what the solutions are to this affordability crisis, they don't match your reality. Home prices have increased 54% in 5 years, which is an unprecedented increase for the US housing market. You can no longer afford the home you could have afforded 5 years ago. And everyone is just saying that we need more supply. People aren't mad that they can't afford any home. They're mad that they can't afford the home they could have afforded back in 2019. People don't want to live in tiny condos, tiny apartments, or a 900 square foot house that's affordable. They want to live in a house that they could have bought 5 years ago. People want a safe and independent space that they can raise their families in. Unfortunately, that is no longer the world that we live in. To summarize this affordable supply myth, watch this clip of Jason from the All In podcast.
These elite lunatic kids in New York City or San Francisco think they deserve to live in Manhattan. You don't have a God-given right to live in Tokyo, France, Hong Kong, or any of the major cities. You need to live in the suburbs. You need to commute an hour to school.
France is a country.
The reality was that pre-sickness, 2010 to 2019, homes were more affordable. Now, yes, housing has never been the most affordable thing in an economy, and that's fine. It was just more reasonable than it is now. Home prices don't just miraculously increase by 40%. The cost of living crisis that has come from that increase is a government-induced problem. And now we're staring down the barrel at more government-induced solutions that will make the problem even worse. So here's what happened. Back in March of 2020, when the credit markets froze, the government and the central bank were looking out into the financial abyss. The Fed dropped interest rates and restarted QE. As a part of their purchasing program, they printed bank reserves and purchased government bonds and mortgage-backed securities from their member commercial banks. Now we're going to ignore the bond side of this and just focus on what's important to this video, their doubling of their mortgage-backed securities holdings. Pre-2020, the Federal Reserve owned $1.4 trillion worth of mortgage-backed securities, and by 2022, they had doubled their holdings to $2.8 trillion, an increase of over $1.4 trillion in mortgage-backed securities holdings. The Federal Reserve, which by the way is not federal and has no reserves, it's a quasi-private institution owned by its member commercial banks. This Federal Reserve backstopped the housing market by purchasing mortgage-backed securities. They were the buyer of last resort because they needed credit to flow. They wanted more people buying houses and more people buying expensive houses because they just needed credit to flow. They needed this new lending to increase liquidity in the US economy. Because if they didn't, like I just mentioned, the government and the Federal Reserve were staring into the financial abyss. They were looking at a crisis worse than 2008 and worse than the Great Depression. They could either let the economy just suffer for a few decades, or they could do what they always do, expand credit and kick the can down the road. Now, before I go any farther in explaining how the Fed's actions impacted the housing market that we have now, I want to jump to today and talk about why interest rates are where they are. Why are they so high? Okay, to explain more about where we are in the current housing market, we're going to use an example. Let's say you were in the market for a $500,000 home, and this was now your asset. But to buy it, you put 20% down, and you took out a $400,000 mortgage from the bank. You now have an asset of $500,000 on your personal balance sheet and a liability of $400,000, which is your mortgage balance, and so you have $100,000 of equity in your home. Now, what happens with that loan? Well, that loan becomes an asset for the commercial bank that lent you that money, and they're stacking it with other loans, probably around the same amount of $400,000. And they bundle these mortgages together and put hundreds, if not thousands of them in a mortgage-backed security, and then they sell that off to an investor. And there's one important thing that we need to understand about mortgages in the United States. It varies over time, but people typically have their mortgage for 7 to 12 years. And during the duration of that loan, it is the asset of either the bank or the investor, whoever owns it at the time. And while that mortgage is in existence, it's your liability, but that means that it's an asset for either the commercial bank that keeps it on their own books or the investor who purchased it from them. Because it's a fixed income security with the lifespan from 7 to 12 years, depending on the decade, it rivals the nearest, safest asset in the market, the 10-year government bond. And the 10-year is the benchmark when it comes to US mortgages. Now, because the government is viewed as the most faithful creditor for different durations, they will always get the best interest rate. So right now, let's say the 10-year government yield is at 4%. So right now, we're not going to see mortgages at 4% because no investor would want to buy that loan. Let's say an investor was picking between two securities to buy. One was a 10-year government bond yielding 4%, and another was a 4% mortgage for a W-2 employee. That investor is going to pick the US government every single time. That's why mortgages need to have a higher yield than the 10-year to entice investors to buy them. And this is where we get our spread. Now, this is going to get a little technical. I've tried to do my best to keep this as simple as possible, but this is really important if you're in the market for a mortgage. Back in 2021, the 10-year was at 1.45%. Now, the reason why the 10-year was so low was for a few reasons. One, the Federal Reserve had lowered short-term interest rates to basically zero, which acts as a floor for all interest rates. Plus, there were many investors that were still worried about deflation and future economic growth for the US economy. And those are the two inputs for the 10-year yield, growth and inflation. And back in 2020, 2021, and early 2022, the market was worried about deflation and US economic growth. And so if you look at the 10-year back in 2021, it was pricing in a nominal GDP of 1.45%. And the average 30-year in 2021 was 3.15%, showing a spread of 1.7% or 170 basis points. But how about now? How about 2025? Here at the end of 2025, when I'm recording this, investors are still a little worried about inflation and have high expectations for future economic growth. So it's pricing in nominal GDP at 4.3%, but we're seeing interest rates at 6.7%. But the average interest rate this year is 6.7%. This is a spread of 240 basis points. And the reason why this spread is so much wider now than it was back in 2021 is simply because the Fed is no longer buying mortgage-backed securities. This is how people were able to get 2.75, 3% mortgage rates back in 2021. Yes, the Fed funds rate was low. Yes, the 10-year yield was low, but also the spread was really compressed between the 10-year yield and 30-year fixed rate mortgages. So if the 2021 mortgages had the spreads that we have today, the bottom rates would have only been about 3.5 or 3.75%, which is still low, but not as low as they were back in 2021. And so something to keep in mind is that we are probably never going to see two handles on 30-year fixed rate mortgages. We may not even see 3% mortgages again. And the reason why people got those incredible interest rates back in 2021 was not because they were great investors or timed everything perfectly, but it's because the Federal Reserve wanted to increase credit in the economy, and so they backstopped the US housing market by increasing their mortgage-backed securities holdings by $1.4 trillion. So that's great. If you had a house or bought a house back in 2020 and 2021, not so great now. It really was the perfect storm. You had low nominal GDP expectations, you had low inflation, you had the Fed funds rate at zero, investor confidence through the floor, and then your central bank was buying trillions of mortgage-backed securities, compressing that spread between government bonds and 30-year fixed-rate mortgages. And that perfect financial storm that led to very cheap borrowing is why housing prices are 54% higher now than they were back in January of 2020. Okay, the Fed buying mortgage-backed securities was only number one. Number two was the federal government giving out helicopter money. There were PPP loans, stimulus checks, there was a federal eviction moratorium, federal mortgage forbearance. There were so many things that changed during 2020 and 2021 that allowed people to have so much extra income. So with lots of money in the system and very cheap borrowing rates, where did all of that money go? People bought houses, a lot of them, and they paid a lot for them. Because with more money in the system and even lower borrowing costs than we had in 2019, a lot more people could buy houses at 2019 prices. That's why in 2026, 2027, 2028, you can no longer buy a house that you could have bought back in 2019. And you can thank central bank and government intervention for that. But we're going to touch on the future of housing prices at the end of this video, but it's important to close this loop on the affordable supply myth. Bringing more supply to market will not drastically bring prices down, but they may anchor prices where they currently are, and you may see a little bit of softening in certain areas. The reality is that the damage has already been done. Unless we have another 2008 great financial crisis where we have deflation, we're probably not going to see housing prices come down that much. So yes, it's important that we have more affordable supply, of course, but you're seeing the current administration throw out threats to home builders to build more supply, which makes no sense to me.
More home building going on, saying in a post on his True Social that he's kind of comparing what he's calling big home builders to OPEC, keeping their oil prices high. He wrote in his post, "They're my friends. They're very important to the success of our country. But now that they can get financing, they have to start building homes," saying they're sitting on 2 million empty lots, which is a record. "I'm asking Fannie Mae and Freddie Mac to get big home builders going, and by doing so, help restore the American dream."
I promise you, if home builders were selling all of their inventory the moment they broke ground, they would build as many houses as they could to take advantage of that demand. We saw them do this back in 2020 and 2021. But the reason they're not building an endless number of homes right now is because there isn't an infinite amount of demand. And forcing home builders to build more affordable homes that the free market has not told them it wants is a great way to make this problem permanently worse. You see, this is the problem with government intervention. The government and central banks create the problem, and then they try to come up with solutions because people are mad about a problem and they look to government to fix it. And government intervention will only make the problem worse. So here's what would happen if the US government actually forced more output from US home builders. And let's use another example. So the government trying to tackle this problem says that US home builders need to double their output. So let's say a home builder is building one home a month and selling one home a month. And the government forces all builders to double that production. They have to increase to 2 homes a month. Now that seems good on paper. Once you've realized that they've negotiated with trades and materials producers to achieve that 1 home a month, when they have to bump up to 2 a month, there's going to be even more demand for those products and probably adding to inflation. But what if they build that second home and they're not able to sell it? And that happens for a second month and a third month. Using this extreme example, you can see the problem. This would put many home builders out of business because home builders don't make as much money as people think they do. So any marginal impact to debt or lowering the price too much could legitimately drive thousands of local home builders out of business. And that's how you would permanently make this problem worse. So when they go out of business, you have even less supply. You have less affordable housing, and this problem only gets worse from, you guessed it, government intervention. And don't even get me started on the 50-year mortgage. And quickly, before we move on to interest rates, Lennar, the second largest home builder in the US behind D.R. Horton, reported that they're giving out an average of $50,000 in the form of price cuts, seller concessions, or rate buydowns. If there really was this insatiable demand for homes and we just need more supply, why are they handing out $50,000 per home to just have someone take it off the market? By the way, if you're in the market for a home and can afford a new construction home, there are some really great deals right now, and you could probably get a great rate buy down with a new construction builder. New construction homes are actually more affordable than existing homes right now because builders have quotas to meet. They have a certain number of homes they want to build and sell each year, and so if something's not moving, they're going to drop the price or add an incentive to keep their production numbers in line. But new construction realistically can't come down that much more than it already has over the last year because builders have costs that have permanently gone up since early 2020. Land, materials, labor, overhead, all of these things have experienced massive inflation. So from a cost perspective, it is much more expensive now to build homes than just a few years ago. So if the market does start to crash, which I'm not anticipating, but let's say it happened, you'd probably see a lot of builders lower production rates because the margin just isn't there. So the government can fake get mad at home builders all they want to try to shift blame and say that the solution to this problem is more affordable supply. But the affordability crisis we're in was caused by government intervention, and most of the damage has already been done. That was the end of the affordable supply myth. Now let's talk about the end of the 40-year bull market. After the government unleashed endless amounts of cash into the economy and the Federal Reserve created an environment for very cheap borrowing rates, 30-year fixed rate mortgages dropped to levels never seen, some as low as 2.75%. The federal funds rate was at 0, the 10-year was around 1.5, and the low for 30-year fixed rate mortgages was around 2.75%. But the problem of mortgage rates dropping to 0 is where do they go from there? Everyone that you've ever talked to about real estate, your parents, a rich uncle, a friend, a finance professor, they've only experienced a market where interest rates go down, and that world no longer exists. You see, the real estate market and the bond market have been in a 40-year bull market fueled by the interest rate reset that happened back in the 1970s. At the end of the 1970s, Fed Chair Volcker, trying to break the back of inflation, raised short-term interest rates up to 20%. They basically couldn't fix inflation and just tried turning the economy off and turning it back on again, and it actually kind of worked. And ever since that hard reset, rates going down has been a tailwind for bonds and real estate. And that ended in 2021 when interest rates finally bottomed. So if you go from 20% down to 0, you really can't go any lower. The US now has $37 trillion in debt mainly because interest rates have gone from 20% down to zero, so they've taken advantage of low rates. And if the economy will continue to be strong and the bond market continues to price in higher nominal GDP, you're going to see the 10-year yield go higher. And with wider spreads, you're going to see mortgage rates probably hang around 6-7% in perpetuity. So really, in a weird way, if you want housing prices to go down, you want a recession. You want the outlook for economic growth and inflation to come down so that rates move lower. But if that happens, that probably means that unemployment has gone up and people have lost their jobs and they may not be able to pay their mortgage, or they may not be able to qualify for a new one. But the result of all of this is that real estate in aggregate has likely topped, at least in real terms. It'll probably nominally increase into the future, but if you compare it to other hard assets like gold, real estate probably topped back in 2022. In one aspect, this is a good thing because it will naturally de-lever the US housing market. And this is sort of a good thing because you don't want housing to become a highly financialized sector like we saw in 2006 and 2007. And my hope is that housing returns to being more of a use asset and less of a financial asset. A use asset is something like a car, a computer, a camera. Yes, it retains some value as you're using it, but you don't buy it because you think it's going to go up or hold its value into the future. You buy it because of the utility it offers you. A financial asset is an asset that must go up in nominal terms because it's part of the collateral base of our debt-based monetary system. Housing prices in aggregate cannot be allowed to collapse in a substantial manner because it's the collateral base of over $13 trillion in mortgages. So if housing prices fall too far, you're staring at a deflationary crisis that sends you into the financial abyss. But as much as I wish housing would go back to being just a use asset, the sector is so financialized that it's probably not going to happen anytime soon. So as we move into the later part of the 2020s, here's what you need to know about interest rates to get the best rate on a future home. If you want to know where interest rates are going, follow the 10-year, not the Fed. Too many people think that if the Federal Reserve drops interest rates, that means mortgage rates come down the very next day. That's not what happens. And in fact, the last few times that the Fed has lowered their federal funds rate, the overnight interbank lending rate that they hope will set the floor for interest rates, every time that they've lowered rates, you've actually seen the 10-year go up because it's a buy the rumor, sell the news event. The 10-year is pricing in the rate drop, and then when it finally happens, it returns to some sort of mean because the banks borrow short and lend long, and they capture the spread. So if you want to know where interest rates are going, follow the 10-year and also follow growth and inflation, or a great number is nominal GDP. If inflation and future economic growth are going down, you're going to see the 10-year yield come down, and that's going to result in lower mortgage rates. And one thing to know is that the Federal Reserve has stated that they have no future plans to buy mortgage-backed securities. After 2020, that was it. Their main focus in the future for any sort of asset purchasing program is to backstop the federal government and their $37 trillion of debt. The housing market is just going to take the backseat for the future of Fed policy. And this is critical because that means that the current spread that we're seeing around 240 basis points is probably what we're going to continue to see moving forward. And we're no longer going to see the 170 basis point spread between the 10-year and 30-year fixed rate mortgages. There's a great chart that shows the relationship between interest rates and asset prices. And as interest rates go up or down, you see its impact on asset prices. When rates were at 3%, houses were obviously more affordable. And now that we're north of 6%, houses are much less affordable. So currently we have downward pressure on housing prices. When rates were at 3%, houses were 33% more affordable than they are right now. Now, the real world doesn't always line up with theory. Like, we haven't seen housing prices go down by 33% since interest rates have started to go up, but we're starting to see some pressure on the margins. So in areas where it's easy to build, where there's a lot of available land, you're probably going to start to see a cap or a ceiling on housing prices. Suburbs that are maybe an hour outside of major cities, where there's plenty of available land to build on, these are the areas that are the most vulnerable to seeing either a pause in home appreciation or even a decline. That's because when you can add affordable supply, that's when the marginal impact of those higher interest rates really come into effect. And when there's a lot of building, you have builders that are able to lower their prices to meet demand and continue to move homes. And so that's where existing homes are going to have the most softening when it comes to their price. However, on the other hand, there are still a lot of desirable areas to live in the US where it's very difficult to build new homes. New York City, San Francisco, Los Angeles, desirable neighborhoods in any major US city. These areas don't have any more available land, and it's generally where people want to live because it's close to work, it's close to airports, it's close to restaurants, it's close to shopping, it's close to other major sites. And there's very little that more supply out in the country can do to lower housing prices in the desirable areas. So right now we have a K-shaped economy where the rich are doing really well and holding up the entire economy, and the poor are really struggling to get by. And in the same way, you have a similar dynamic in the housing market. Interest rates are putting downward pressure on housing prices prices out in areas where it's very easy to build, but in desirable areas and even higher end luxury real estate, we're probably going to see home prices continue to appreciate because the rich have more money to spend and they want to live in specific areas. You also have to think about purchasing power. Older people typically have more money, and if you've owned a home or been heavily invested in stocks or other securities over the last 40 years, your portfolio has done really well, and so you can sell a home or sell an asset to buy a house in an area that you want to live. And for young people who don't own a lot of assets, who are just coming out of school with student loans and are trying to enter the housing market for the first time at the end of a 40-year bull market, they're going to struggle. And so if that's you, if you're struggling to break into the housing market and it's something that you desire, I want to encourage you to be patient. If you're looking at homes priced in the bottom 2 quartiles, like if you're not trying to ball out and buy a $800,000 or a $1.5 million house, then I think you have time on your side. If you're trying to get into the housing market and you're looking at homes that are $300,000 or $400,000 and you're not trying to live in a desirable neighborhood of a major US city, you have time to build up cash and make sure that your purchase makes sense for you. The end of a 40-year bull market is not the time to just buy any house anywhere because you just so desperately want to own a home. And there's one last piece of advice that I want to give. So many people think that you can buy a house and then if interest rates do go down in the future, you can just refinance. But from what we've talked about in this video, you now know that interest rates go down because growth and inflation expectations in the future are also going down. And that happens when the US economy is contracting and in a recession. And in that same environment, unemployment is probably going up. And at that point, you're really seeing downward pressure on home prices. And so if you only put 3% down on a house and hope to refinance in the future, if housing prices in your area fall more than 3%, which they likely will if we enter a recession, the bank is not going to allow you to refinance because you no longer have equity in your home. In this made up situation, you probably owe more on your home than the market value. And in that scenario, the bank is not going to allow you to refinance to a 4 or 5% mortgage. And so although planning to refinance in the future is a great plan, just note that if you don't put enough down or you pay too high of a price for your home, that option may not be available for you in the future at a time when you really want to take advantage of it. Also, view housing as a use asset. Don't buy it because you think it's the key to financial success. View it as something that you will raise your family in, or it'll give you a piece of independence, and view it as a way to own property in this great country so you can be a great member of your society. Don't buy it because you think it's going to make you rich or give you financial independence, because right now owning a home is more expensive than renting. There's absolutely no shame in renting because it's a smarter financial choice for you. Be flexible, build cash, and make sure you're investing in other financial assets that do have higher upside in the future. If you're young, it's more important than ever to start building your financial base of assets outside of real estate. And view a home as a great place to live. And if you make money on it, great, but don't worry about it too much.